Take a listen to what Tom Lee just said about the stock market and why you need to be buying these dips. That's exactly what I've said here on this channel as well, and I think Tom Lee is 100% correct. And I actually think we have some pretty big catalysts coming right around the corner within the next, last I checked, 16 days or so.
Is the market now free of the indecisive December choppiness that dropped the average stock by more than 6%? And what are the crucial catalysts to watch from here as January unfolds? Here to take on those questions is Fund Stretch Tom Lee, a CNBC contributor, of course. Tom, good to see you. Happy New Year.
Happy New Year to you.
So first off, Tom, what's your diagnosis of what the market's been contending with here in the last several weeks as we've gone sideways and had sort of this negative skew toward market breadth?
Markets kind of did flail into the end of last year and the first day of 2025. And I think it was trying to digest a few things, that the pretty dramatic move in long-term yields and the dramatic drop in yields in China. I think that there has been some concerns about macro as you saw some events over the past few days. And I think there was general profit taking and some sort of let's wait and see how 2025 is, given we just booked two 20% back-to-back years.
And do you think that those things will remain overhangs? I mean, obviously, you certainly have a bullish orientation. You feel as if the S&P 500 can get to 7,000 by mid-year before perhaps a pullback. Well, if we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Well, I think one thing the viewers need to keep in mind is that just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts. But I think one of the sort of two important things happening early in 2025 is going to be, one, we're seeing manufacturing recover. The ISM manufacturing, posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years. And the second is that I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market.
And in terms of perhaps the same themes being in place, does that mean that the leadership profile of the market you expect to stay similar to 2024? I mean, I know it's waxed and waned between mega cap growth leadership and then some broader participation, but we did finish again with dominance by the NASDAQ 100 type stocks.
Investors still are going to pay for earnings visibility, and that's why I think the Mag 7, including NVIDIA, are going to be important holdings. But financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrials, and small caps. So I think that there should be a case for broadening of the markets this year. And then finally, I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin, and at 97,000, it's still telling us that, this is still a risk-on market.
Yeah, I mean, obviously it's held almost all of its gains since that little poke above 100,000 in Bitcoin. Although I do wonder what you make of the relatively heavy outflow we were seeing in the BlackRock ETF that holds Bitcoin, whether it was just sort of deferred profit taking into a new tax year or something else.
It's hard to tell. And I think with the ETFs, it is creating, I think, an interesting dynamic, which is that someone who sells a BlackRock ETF doesn't have a 30-day holding period if they buy another Bitcoin ETF. So I think in some ways you can see people doing basis swaps and stepped up in tax optimization strategies and not really having to worry about that.
Now, whether or not you agree with Tom Lee or not, I don't care, clearly. I don't agree with everything that Tom Lee says, but I think he is correct in saying this is a buy the dip market. When you get opportunities, you want to buy them, okay? And I still think we are in an opportunity. I don't think that opportunity is past. Yeah, sure, maybe you did not catch the exact bottom, but when you look at the percent of stocks trading above their 50-day moving average, it's still only at 38%. Anytime you've been in a bull market, which last I checked, we were still in a bull market, nothing changed with the bull thesis. If something does change, I will let you know. I'll be the first one to flip-flop, as you probably already know. But anytime you're at these levels, you want to be buying. Up until you get into the high 60s, as far as percent of stocks trading above their 50-day moving average, you want to be a buyer here. Okay, and that has not changed. You've actually only went from 28% of stocks above their 50-day moving average to 38%. So you're only up a little bit. On Friday, you were up 4.2%. So 4.2% of stocks went above their 50-day moving average. Overall, 62% of stocks are still in an active decline. And there's still a lot of damage done with something like the RSP. This is the equal weight S&P. You're still down from your all-time highs, even following Friday's bounce, about 6%. At the lowest point, you were down about 8%, okay? You pretty much had an internal correction in our markets. Now, big tech is held up a little bit better, okay? So you didn't get that headline correction in the S&P. I do worry about big tech because industrials, cyclicals, small caps, name the sector, and we should see some pretty good earnings growth. Whereas in 2023 and 2024, a lot of the earnings growth was really just in your Mag 7. So it was really easy to justify owning those names. That is less of a case today as it was before. So I do worry about big tech and their leadership. I do think there's a lot of reasons to really broaden out. And if big tech doesn't participate as much, you're going to see less of a headline gain on the S&P, but more of an underlying gain on our markets. Now, CNN's Fear and Greed Index is at 32, which is still in the bottom third of fear, this fear category. Still, I mean, there's a lot of room for some improvement here, okay? Now, the percent of investors that are bullish also hit a new low for at least since the election, sitting at 35.4%, below historical averages, and this data came out on January 1st. Neutral investors has really risen from 25% on December 11th up to 30.4% now. And bearish investors remain pretty stable, actually, from December 25th through January 1st, 34.1% on December 25th, and 34.2%. So a little bit of a move up for the January 1st reading. So you're negative on the AI Investor Sentiment Survey. Percent of stocks trading above the 50-day moving average is still very negative. CNN's Fear and Greed Index, very negative. I mean, it looks to me like there's a lot more room to see a bit of a rally here. Okay, the Fed on Friday also said that they want to keep asset prices higher because if asset prices are higher, then people will continue to spend and make the soft landing easier to actually obtain. Now, the next big catalyst we have for markets will come next week. We do have quite a bit of data that will be coming out. We will hear from more Fed officials. I will give you a rundown of the data here now. Now, we did have ISM manufacturing PMIs that maybe helped cause some of the rally on Friday. I think a lot of it was some tax loss harvesting getting bought back, a little bit less profit taking, and more obviously positioning into our markets. I'm not the only one that can sit here and say, you know, when these three indicators, AI Investor Sentiment Survey, percent of stocks above their 50-day moving average, and CNN's Fear and Greed Index are all this negative, you want to be buying. Like, this is not a super crazy call. This is just the right call, right? Anytime you're in a bull market, you want to buy when these things are this negative. Now, manufacturing improving on Friday could have also been a positive catalyst as well, but I don't think you can blame the whole move higher based on the manufacturing PMIs. Now, on Monday, you will get factory orders, you will get composite PMIs, services PMIs, some other things as well on Monday. On Tuesday, you will get the ISM services PMIs, expecting those are going to move upwards about 2 points. And JOLTS job openings, expecting those to fall by about 100,000. If you fall, I mean, as long as it's not a huge fall, not a big deal. On Wednesday, you will get the ADP employment change as well as Fed Waller and the FOMC minutes. The ADP employment change likely to be the most important thing there. Thursday, you will get Challenger job cuts, expecting those are going to ramp up after, the holiday. That's not a huge surprise. Fed Harker will speak as well on Thursday, initial jobless claims. And then on Friday, your big data will be coming out with non-farm payrolls and the unemployment rate. Now, you're expecting about 150,000 job ads and the unemployment rate to move up 0.1% to 4.3%. This could actually, as Tom Lee says, allow the Fed to be more accommodative to the business cycle. We could actually start to price in more cuts if this jobs report comes in line with expectations. Now, this is going to be a big catalyst, but I do think the next big catalyst is obviously we have bank earnings that start on January 15th, and earnings season will be important. I think overall earnings season is going to come in really good. It's a holiday season. I don't see why earnings would come in bad. And especially as the markets have recently sold off, I think it's going to make markets look a little bit better, right? You might want to, get some exposure before this fourth quarter earnings season does get started on January 15th. But the inauguration on January 20th. Now, I'm going to explain this in, I think, one of the best ways that I can, okay? And I hate to use medical kind of examples here, but the inauguration, the big thing that is the fear catalyst is tariffs, okay? Now, we're kind of preconditioned to expect some pretty big tariffs. So Trump could get away with like a 10% blanket tariff, and the markets would rally on that. We would say that's bullish because on the campaign trail, they were talking about 100% tariffs and blah, 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 blah. So you could actually, at this point, if you're Trump, get away with something that maybe otherwise would have been seen as negative because you've preconditioned investors and markets, everyone basically, to expect some kind of aggressive tariff situation. Now, coming January 20th, and therefore afterwards, you could actually see a rally in markets, a buy the news event, because there's a lot of positive Trump policies as well. And again, we're already preconditioned to expect some pretty negative tariff policies. So actually, after January 20th, I'm pretty bullish on the prospect of a larger rally that could come. A buy the news kind of situation. And think about the tariffs like this, right? If you go to the doctor and you're scared, you might have pneumonia, or you might go, have to go to the hospital or something. You're really sick, and then you go to the doctor. They do your chest X-ray, and you find out you just have bronchitis and a really bad sinus infection. You're going to be kind of excited because you were thinking worst case scenario, you're going to have to go stay in the hospital. Right? Maybe you've already been to the hospital before for pneumonia and you kind of, thought it was the same thing. That's kind of like the tariff situation. Like, it's bad. You got a really bad sinus infection. You got some really bad bronchitis going on, but it's not pneumonia. That's the bright side, right? 100% blanket tariff on China would be like pneumonia and hospitalization, and bronchitis would be like a 10% tariff, right? It'd be good for markets. So I hate to use a medical analogy, but that's kind of the best way to think about a potential buy the news event around the inauguration. And as I explained in the last video, there's three big risks for 2025. Number one is inflation goes up again. The Fed has to raise rates. That's a big problem. Number two is too aggressive tariff policies. And number three is if the economy starts to slip into a recession or close to that. In those three scenarios, the bull market will end, okay? It will cease to exist, at least temporarily, okay? Minus those three, I don't see earnings as a big risk to our markets. I don't see geopolitical, problems as a huge issue at this point. I don't think there's really anything within reason that we can forecast right now that would be a big negative problem for our markets that would end the bull market. So minus those three things happening, I want to be buying any and all dips that we get, because I do believe in the same thing that Tom Lee believes in, that we will see a broader market rally in 2025. I'm not as bullish on big tech as Tom Lee is. I think they will participate, but it's kind of like Microsoft. Microsoft is the biggest client to NVIDIA. They buy the most semiconductors, and they were the lagger as far as big tech. They were only up 12% on the year. As far as Mag 7, that's really bad. That's half of what the S&P returned last year. I do think the gains are really going to broaden out. And I do think cyclical, small caps, industrials, right? AI appliers are going to be the big winners next year. It's not just going to be big tech. Even if big tech is kind of in line with the markets, market perform, if you will, small caps and those other areas could well outperform the markets, in my personal opinion. And then your AI appliers, like some of your software names like a MongoDB or Elastic or Applied Digital for data centers, Novartis Semiconductor is kind of a high risk, energy efficient semiconductor, Tesla, right? These stocks could more than double in 2025, in my opinion. Okay, that's just my opinion, but I think it's the year of AI application, not just semiconductors and who's buying the most GPUs that gets rewarded the most. So let me know what you guys think about this information down below in the comment section. Ladies and gentlemen, have a fantastic weekend, and I will see you in the next one.